Hey, have you ever wanted to get into investing but didn't know where to start? Is it all a bit too complicated and hard to navigate and understand? Well, today I'm going to go through a few steps you should go through before you start to invest. So today I'll go through 3 steps. And the 3 steps essentially are what you need to know prior to investing, what you need to do once you understand your individual needs for investing, and finally, the 3rd step, you need to make sure you stay the course. And it's really that simple, that 3-step process that you need to go through to ensure you have a successful investing strategy. So let's start with the first step. The first step is that before you invest, you need to understand your individual needs, circumstances, and goals, and what that means for you when investing. So essentially, you need to find out what is your budget. What's your budget for investing? What's the size? How often are you going to be investing? Are you going to be putting a little away every month or every week? Or do you have a lump sum that you're going to invest? You need to know your budget and understand what your budget is. Another thing you need to understand when investing is your goal. What is your goal for investing? And essentially, what is the time horizon, or how long will you be investing? So your goal will be to either, do you want to save for a purchase like a car or a house, or do you want to save for something longer term like your children's education, or do you want to save for retirement? And each of those goals will have a different time horizon, or will have a different time essentially linked to each of those investing goals. And you need to be clear what your time horizon is, because it's really important to align your investments with your time horizon. Essentially, the longer term investment time horizon you have, the more options you have available to invest. If you have a shorter term time horizon, i.e. if it's less than 1 year, you're investing for less than 1 year because you need that money for a purchase at the end of the year, well, you need to make sure that you have your money available to you within that time period as well. Another thing with the time horizon is you need to understand your liquidity. So what does liquidity mean? Essentially, how soon you need to cash out that investment, or how often do you need cash related to your investment to ensure that you can make payments to some of your goals. So for example, if you were saving to make a purchase, you need to make sure that at the end of your investing period, you will have the cash ready to make that purchase. So if you're purchasing a car and you need that money straight away at that time, well, you need to make sure that your investments allow you to either withdraw or redeem the funds available in the timely manner when you need it. So for example, if you're investing for less than 1 year, you might consider just doing maybe a term deposit, because at the end of 1 year, you'll have the money back with interest. And the principal is also guaranteed if you invest in a bank backed by the government. You also have to consider your risk tolerance. How much risk are you willing to take with this investment? Essentially, your risk is, so that's up to the individual, what risk you're willing to take, but also because of your investment goal, you might be able to take more risk because it takes a longer time horizon. If you had a longer term time horizon, you might be able to withstand some of the ups and downs in the market, because your investment horizon is 5 years, 7 years, 10 years plus. So the up and down in the market today might not affect your returns as much as if you had a shorter term time horizon, where the up and down will definitely have an effect on your ability to take on risk. So just essentially the first step is knowing your limits. And with knowing your limits, it's just understanding what your investment budget is, what are your investment goals, and with that, what's your time horizon and liquidity, and also what type of investment risk are you willing to take. So that's step one. Essentially, it's outlining all your limits for investing and understand what you want to do, what you want to achieve with investing. So that's step one. Once you understand where you're at in terms of your investment limits or your constraints, so you know what your budget is, what you're going to be investing, what your investment goal is, how long your time horizon for investing is, and also what your liquidity is, then you have to find an investment that suits, or an investment strategy that suits those goals. So essentially, if you had a shorter term time horizon, for example, and you really needed the money guaranteed within a year, you'd be very limited in the type of investments guaranteed of your funds at the end of that period. So essentially, with a short time horizon, you might be limited to your investments. So essentially that might be a bank product, bank deposit, or maybe safe blue chip stock investments, or even potentially an ETF that you might invest in, stock index ETF. But even that could be risky for less than a year, because in less than a year there could be up and down movements in the market. So that has to be all considered within your investment. Essentially, step two is making sure the investment strategy or investments that you choose matches with those constraints that you figured out in step one. So a good example is, if you had a long-term time horizon and you want to invest in retirement, and you found that property was an appropriate investment for you, and you were investing in a property, and then you got investment returns from the property, and you rented out the property, and every month you would get investment returns from the property, and that matches with your investment goals, that might suit your investment goal because it's a long period of time and you're willing to take on that liquidity risk and that time horizon with the property. Because essentially, if you're investing in a property, you wouldn't be able to sell that quickly if you needed the capital, the total capital up front. And if you found out that your liquidity requirements could be met with the rent that you receive from the property, then that's a tick. And you're willing to hold the property for a long period, that's a tick. And it's within your budget, within your investment budget, you can pay the repayments of that property, that's a tick. And it's within your risk tolerance because you understand properly the risks of it, that's a tick. So that's the sort of thing that we're looking for in step two, essentially picking an investment that matches your limits in step one. And not just with property, you could also be investing in, say, S&P 500 plus some bank term deposits plus a property. You would invest in each of these every month, and a certain amount of your investment would go to bank deposit, a certain amount will go to S&P 500 index portfolio, and also a certain amount would go to your property portfolio. Step two is constructing and choosing a portfolio which matches your step one investment goals, constraints, matches your budget, matches your investment risk, matches your time horizon, and also matches your liquidity. And step three is essentially just implementing and staying disciplined with your investment strategy, because you've already done all the work with step one and step two, and now it's just actually staying disciplined and continuing with that investment strategy, assuming no changes occur in your individual circumstances. Now, if there are changes, say you need to change your investment strategy because your budget changes or your risk changes or potentially your time horizon or liquidity changes, then those could be good considerations for changing it. But you wouldn't just change your investment strategy because the market has changed in terms of what you're seeing currently, because what you should be doing in step 2 is looking at the long-term expectations for your investments, not the short-term expectations. You're saving for retirement, and that's in 30 years, and you're investing for over 30 years. But because of changes in the market, you wouldn't change how you invest overall. Essentially, you wouldn't change your investment strategy, i.e. you wouldn't divest from equities, or you wouldn't just sell your property, or you wouldn't just stop investing in a bank deposit because all of a sudden you think the market has changed in the short term. You have to stay disciplined and stick to investing in your strategy in the longer term. What would happen is if you all of a sudden change your investment strategy midway through, essentially you're not going to get the outcome that you were looking for, that we're trying to assess for in step 1 and 2. So essentially this 3-step process is just trying to get the outcome that you want. So essentially the outcome is you want to save for retirement, and in 30 years you want X amount saved from your investments. And how would you achieve that? Understanding your limits, and then within those limits choosing investments which match those investment limits, and then essentially it's just implementing those limits. I hope you found this useful. Very simple concept. You first have to understand what your limits or constraints are with investing. Step 2, pick investments that match your investment limits and constraints. And that might entail doing some research on the investments as well if you don't fully understand all the type of different investments out there. And then step 3 essentially is implementing and staying disciplined and continuing investment strategy overall, and only really changing the strategy if one of your limits changes. So if your budget changes, or your risk tolerance change, or your time horizon or liquidity requirements change, then that's when you should be reassessing your investment strategy. Hope you found this useful, and hit the thumbs up button if you did, and keeping it champ in your financial journey. Cheers.